the most important thing that you need to do as an investor is that you need to understand what your strategy is. A. B, because if you want to make money, right? B, you need to understand how to value assets, stocks and bonds or whatever. 3, you need to know exactly what's going on in the market. Okay? So let's start with the last one. What's going on in the market? What the heck is going on in the market? The market essentially last week started to take a bit of a nosedive as far as the NASDAQ is concerned. So there's some uncertainty out there. And uncertainty is the last thing you want as an investor. But it's also the first thing that you want an investor because it allows you to take advantage of the situation. And that's the beautiful thing about it. So that's the first thing you need to know. You need to know what's going on in the market. How do you find out what's going on in the market? Well, frankly, you need to go out and get as much news as you can. But be careful. Be careful. Because, let's say you listen to, CNBC, and you look at all of these outlets. What is it that they do, right? What is it that they do for you? They basically bring in a bunch of people to talk about stocks, which is great. And they talk a bunch of people talking about news, which is great, about what's happening with the company. But there's an assumption in there is that the price risk, meaning the volatility of the stock price, is tied to the credit risk, right? So obviously they want you to listen. They want you to see what is going on. They want to talk to you in a language that you understand. But is that truly the real language that you need to know? Is it that's what truly drives the stocks? Marcus Aurelius once said, Marcus Aurelius, by the way, is this Roman emperor. You remember the movie with Russell Crowe, Gladiator? He was portrayed in that movie. And basically what he said was that you need to don't read too much. Meaning try to get into your own thoughts and come up with your own ideas, your own way of thinking. That's what he wants you to do. He wants you to be your own man or woman. So obviously, if you're going to listen to CNBC and they're telling you what they think is happening, then it prevents you from thinking about what you think is happening. And that's not always the best thing. You want to be able to basically make up your own mind. And how do you make up your own mind? Well, you make up your own mind by thinking, by digesting the information. And thinking, it is not something that we do well. As I told you before in previous video, we are geared towards thinking that we want to be as efficient as possible. So we don't want to do too much thinking, because that may be a big waste of time. We rather our brain do the thinking. And our brain, what's going to happen is she's basically going to tell you what she thinks is happening quickly. Now, you need to take a hold of it and say, is this really what's going on? That is not always a good thing to do. That's because investors tend to want to know right away. And if you don't know right away, then it's a big waste of time. So he's basically saying, make up your own mind and you write the books. You decide what's going on. You set the tone. Unfortunately, that cannot be, right? We cannot all do that, because then nobody will be listening to the radio or to YouTube and you and everything else. So there's got to be a happy medium. So what do we do? What do we decide? Well, what we decide to do is basically get a feel for what's going on in the market. Listen to what they have to say, but understand that their goal is for you to watch what they are selling. Right? How's CNBC and Yahoo Finance and these people make money? Right? They bring you portfolio managers, and the portfolio managers tell you what they're investing inside their stocks. But that doesn't mean that this is the one way to go, because it's basically they're pumping their own game. right? They basically tell you what they want you to buy, because if a bunch of people, if a portfolio manager comes out and say, hey, I love this stock, and everybody buys the stock, you say, you see, I told you should buy the stock because it's going up. Come on, we got to be smarter than that. The way you become smarter is you decide on your own what you think is going on. Now, of course, you need some input, right? You need to know kind of where everything is happening. You need to look at the information, look at everything that's coming in, which is basically a bunch of reporting of information, and then you need to analyze. You need to analyze what's happening in the stock market. You need to make up your own mind, basically. You need to decide what you think is really going on based on the things that are happening out there. You know, it's the same thing as simple as you crossing the street. You're going to be out there, you're going to cross the street, and you're going to be deciding, okay, I don't see anybody on the right, I don't see anybody on the left, so it is safe for me to cross the street. It's kind of the same thing. I mean, you do it intuitively because it's kind of easy to do. Here it's more complicated because you need to find out what's going on in the market. Where are these people all doing? What is where's the wind blowing? And I'm listening to these people and they're telling me the Fed is going to lower the rates. Right? That's what they're all saying. Well, then that's a good news for stock because they're buying it, so therefore I should be buying stocks. You know what else is going up? Gold is going up, and that's a concern. Because when gold is going up, they're concerned that there's inflation, and more importantly, there's a loss of value somewhere. So be aware of that. I'll do a separate video on gold. Don't forget, like this video. You have to like the video, and you have to subscribe. Otherwise, it's a waste of time. Anyway, so you need to get a sense of what's going on in the market, which I think by now you have a good sense of what's going on. Because you read about it, you hear the tea leaves, you hear what they're saying, you hear Kramer and all these guys on CNBC, and you hear Bloomberg and Bloomberg surveillance. All that information is coming in. They're feeding it to you so that you have a kind of an overload. At the end of the day, you start to make a decision, because one thing you cannot do is not make a decision, right? Because if you sit on your cash, then you are not making any money. How do you think you get all this stuff, right? How do you get houses and you get money? You have to decide. You have to decide where the market is going. Okay, so get a feel for where the market is going. Now, once you have that feel, you might be right, I may be wrong. You need to decide. Well, okay, so how much do I have to pay for it? How much is Tesla really worth? How much is Nvidia? How much is Taiwan Semiconductors, which is another name that's coming out soon in one of my videos? How is that? What is it worth? Because I know I want to cross the street, but I don't need to cross the street in 2 seconds. I could take my time because there's nobody around, right? So you need to decide, where do you think the power that be actually deciding? So you need to decide what the value of it is. How do you decide value? Well, value is a funny thing. The value of something is what someone else is willing to pay for it. That's it. Listen, if you're in the desert and there is no water, right? You're in the desert, there's no water. You will pay anything for that water. The same thing is happening with stocks. Nvidia at one point had no growth. Nobody wanted it. Now it's got growth. Everybody wants it. But maybe a little bit too much, as you could see last week, because the NASDAQ went down a lot. It's the worst drop since 2022. Something is going on there, right? Somebody's getting out of the stock. Okay. Anyway, what is it worth? Well, you have to look at the cash flow. I know. I mean, where do I look at the cash flow? Well, you gotta study. You gotta understand. You gotta look at it. You gotta look at the 10K. You gotta look at the financials. It's all available. They give it to you. They're not lying to you. They're available. Now, of course, you could say, well, let me look at the 10K, which is a document that you have to get, which all investors have to get, because the SEC said we need to get to know. We need to give that to the people. But then once the people have the SEC document, if you look at it, it's like 100 pages. They give you a bunch of stuff about the company does, about the financials, about everything that has to do with the company, about the risks. But when you look at it really carefully, you're going to realize that the information that is in the 10K is only the information that the company deems appropriate, and of course some guidelines from the SEC. If the SEC said, you could provide financial if you want to, That would make sense, right? You have to see the financials. But if you look at the SEC, you'll see, for example, this is how they confuse you. And that's how they prevent you from making money. You will see that they tell you a lot of risks on this company. And you look at all the risks, oh my God, I mean, the risk of change in interest rate and the change in tax code treatment, that could apply to anyone. So that's not such a great thing. And that's how they make it difficult. This is how they make it more of a challenge for you to understand what's going on in terms of the valuation. But as far as valuation is concerned, and it's important, right, to understand valuation right now, because the market might be doing a shift to value. Why do they want to shift to value? They want to shift to value stocks because of the fact that there is the economy is slowing down potentially. I mean, unemployment is up a little bit. I mean, we're not there yet. It's just a talking point here at this point. But if that happens, then everybody's going to want to go into safer stocks, or they want to make sure that they're not paying too much for the stocks. And how do you know? Well, you look at the real value of the stocks. And what is the real value of the stocks? It's tied to the cash flow. How is it tied to the cash flow? It's very simple. The present value of a stock is the present value of its future cash flow. You need to know the cash flow of the company. Once you know that, then you discount it back $1,000 at 10%. If I give you $1,000 every year at 10%, forever, that money is worth $10,000 today. I know that for a fact because every year your money loses value. So after 20 years, it's gone, right? You don't care how much money you get 100 years from now because it's not worth anything. What's worth is what the money you have today. Today I have this money. Today is what I have. Today is what matters. And this is what you need to get your head around, okay? So you need to know the cash flow. Where you find the cash flow, it's very simple. You're on YouTube and your iPhone every day. Go on to Yahoo Finance, look at the financial, look at the cash flow, and you have it. Then you look at the EBITDA and you say, what is the right discount rate? I don't know. Just assume 10% or whatever. I mean, right now the discount rate should be around 10, 12%. Discount, take that cash flow, divide by 10%. That is the value of the stock, and divide by the number of shares. That's kind of give you an idea as to what the value of the stock is. So that's going to be kind of key going forward because it's all going to be about the value. What is the value of the stock? You could also look at the book value. Unfortunately, when you look at the book value that's given to you in the financials, they make it confusing for you because that information is outdated. Or let's put it this way. When they say that I have inventory, you know what inventory is, right? It's basically if you own a company that sells sells shoes, right? The inventory is how much shoes you have in your warehouse. How much is that worth? Well, let's say, well, I bought it for $100, but is it really worth $100? If you're going to sell everything today, you may not get $100 for all of your inventory. Maybe 50. When I say 100, I'm talking 100 million. Maybe you get 50 million. Maybe you get 12 million. Maybe you get 5 million. You don't know, but yet they report that in the financials. So when you look at the financials, that might not be what is actually happening. That might not be the truth. That might not be what you think it's worth. So you got to be very careful in terms of using that data to basically evaluate the company. Okay. So how else can I do it? Well, you could basically take a look at the P ratio, because who cares what the thing is worth? What I care is how many times people are willing to spend on a stock based on its earnings per share and its price, right? So right now the market is around, I believe, 30. The P ratio is 30. The P ratio for Tesla is 67. Right? So people are willing to spend 67 times per dollar of earnings, while they're only willing to do that 6 or 7 times for the GM. Right? Doesn't make too much sense. Yeah, because they think that they're willing to spend more money on Tesla because they see more growth in Tesla. So that's a different way of valuing. I don't care, what the cash flow. All I know is a bunch of people are buying Tesla, and they're willing to spend $64 for every dollar of earning. So Tesla is worth more, has more value, has more attractiveness than the other guy. But I will tell you that it has been shown that the way you make money in the stock market as far as the P ratio is concerned is that you need to buy low PE stocks. I didn't say low growth, I say low P, meaning that you want to get on Nvidia and Tesla when the P ratio is 10, not when the P ratio is 67. You don't make money at 67. I mean, as far as the pundits are concerned and the research that I've seen, you don't make money with that. So the way you make money is when you get it on when it's low. But how do I know, if this stock is a P ratio of 10, it's going to be 60? How do I know that? I know back to basics, back to understanding the stocks, back to not paying too much for it, right? So you need to look at the financial. There is no shortcut. You need to know what it is that you're buying, and you need to know how it's valued. It depends how it's valued. If it could be worse valued on the cash flow, so you have intrinsic value, or view on how people are buying it, which is relative value, which is basically how you buy a house, right? When you buy a house, you look at the house, you see what they pay next door. See my previous video on that. But basically, these are the two, right? There's a third way, which nobody will understand. This has nothing to do with anything except that the price moves in ways that are mathematically understandable. And that's difficult to grasp. So I'm not going to go there. And I'm not going to go there because frankly, that is the reason why you're getting the kind of news that you're getting from Bloomberg, right? They talk to you like you're 5-year-old by telling you, look, the company released its earnings and the earnings were good. So yes, buy the stock because the company is making money. First of all, I don't want to know what the company is making today. I want to know how much the company is making tomorrow. I need to predict what's going to happen tomorrow. Because if I can't predict, then I at least have a chance. If you have to assume again that the price risk is driven by the credit risk. Meaning that the way the stock is going to move, it is tied to how much money the company is making. But I will tell you, if that was the case, we would know exactly how to price assets, and we don't. I will tell you that because an asset is worth what someone else is willing to pay for it, therefore it is tied to the emotional aspect of the investors, what the investor thinks. If you have a bunch of dodos buying stocks and they don't know anything and all they do is they keep buying and buying and buying and buying, the stock goes up. The stock goes up. Is it worth that? No, until they decide that it's not worth. And then the stock will go down and down and down and down. You see the dichotomy of the situation that you're in right now? Right? You want to make money, you want to know what to do, but yet you don't want to do the homework, and yet you want somebody to tell you what's going on. That is not going to happen. You need to understand some of the basics. So therefore, my suggestion to you is that you need to shut everything down and think about what it is that you know and understand. Do you know AI? Do you know manufacturing? Because then, there's a lot of people making money as a day trader on just trading one stock because they understand how the stock performs. Not so much that they understand what the company does, but they understand the fluctuation of the stock. Maybe there's a correlation between the way the stock moves and the way it responds to certain items. And that's a concept that we talk about, correlation versus causation. And that's a big deal. It's a big deal. For example, they always say, oh, look, people that have heart attacks have high cholesterol. Oh, so therefore, high cholesterol is causing heart attacks. And they have shown that that's not the case. Because the only way for you to prove causation on something like that is you would have to feed a bunch of people lots of fat and see if they die or not. And the other people, you don't feed them anything. And then you see what happens to them. They haven't done that study. What they have done, they have looked at what people ate, and they realized that wasn't the case. So, that's a different topic altogether. But in terms of causation and correlation, I'm sure when you hear every day, what's your cholesterol, because you're going to have a heart attack. There's no such thing. Believe it or not, Google it, and you'll see soon enough. But the causation of something doesn't mean correlation. Correlation happens to be correlated. People that jump from rooftops die. Because we threw them off the roof and they died. And the people that didn't throw from they survived. Okay, so then we could prove that. That I know. But everything else, how are you going to find out? Right? How do you know that earnings will cause the stock to drop? Are you sure that is always the case? But which earnings? Or is it something else that has happened that has nothing to do with the earnings? In fact, sometimes you see earnings dropping and the stock goes up. Why? Well, because there's not so much that they're thinking what the stock is going to do now, they think about what the stock is going to do tomorrow. So as you could say, it is a very difficult process. It is a process that's always evolving. And unfortunately with AI, what's going to happen is AI, and I'll do a video on that, AI is a very great tool. In fact, some portfolio managers are starting to use AI to decide. But do you know what's going to happen? If everybody uses AI, everybody is going to start thinking the same way. Right? Because you're not making the decision. Literally in ChatGPT right now, what you can do, you could grab the financial analysis and the valuation from Yahoo Finance. You could copy it, paste it into ChatGPT and ask ChatGPT, hey, what do you think? What is the growth of the implied growth in this company? And ChatGPT will tell you. And you could ask ChatGPT, what do you think is going to happen next? And ChatGPT will tell you. I mean, obviously, portfolio managers uses a lot more complicated. My students work on projects having to do with trucks coming in out of factories. They look at the waves and they figure out are the waves going to predict the stock market. There's a lot of things that goes into it. The point being is that it will negatively impact your way of thinking because everyone will be thinking the same. You don't want to be thinking the same as everyone else. And that's the problem with AI. I mean, there's a few good things about AI, but there's a few bad things about AI. And that's the thing that you need to worry about. Where is this going to get us? So that's why as an investor, for you to make money, you need to be buying, essentially, when everyone else is selling, like right now. And you should be selling when everybody else is buying. Whoa, I got to go contrary to popular belief. That is exactly what you need to do, which is not an easy thing to do because you're alone and you rather be with a bunch of people. How do you think Jim Simmons made so much money? Billions of dollars. Jim Simmons was a mathematician that turned into portfolio manager, that turned into a hedge fund manager. How do you think he made money? He made money because he looked at the patterns. He looked at causation. He looked at correlation. He was in charge for goodness sake. He was in charge. He was basically working for the military at one point, describing private messages and encryption, which is extremely complicated. And he was working on that kind of math. That's what you're up against as an investor. How could you potentially make any money? So then what you're going to say is that, well then let me buy a portfolio. Yeah, you could buy a portfolio from a portfolio manager. But understand, as I keep saying every single time, no one makes money. No one beats the market. Well, at least only 30% beats the market. Most of the time, more likely than not, whatever portfolio you're going to get, like even if you see something, oh look, it went up 60% last year, this biotech portfolio went up 60%, maybe it's too late, it's already up 60%, right? And it's the thing is, the portfolio managers, even if he's got a lot of winners, even if he has a great winner, a winner that takes up 90% of the value of the portfolio managers is going to have to diversify, because then this risk position increases, and portfolio managers get paid in terms of the amount of risk they manage. Risk is important for them because you could have a portfolio and have one stock and it's doing great, and you tell your customers, look, buy my portfolio, I'm just buying Nvidia, look how much money I made. That wouldn't work because everyone knows that, but you have a tremendous amount of risk. You're not diversified enough. Now, of course, you could be like these hedge fund manager like Spitznagel. Spitznagel is able to manage that in a sense that he only buy long-dated puts. right? So basically, he's going to bet that in the future, the market is going to drop by 50% to offset his portfolio. But it's not going to drop by 50%. How do you know? But he's going to pay for that privilege to make money when that happens. And when that happens, like it happened in 2020, he made a tremendous amount of money. He made 4,000% on this portfolio. But his investors sign a disclosure. They say, you're not going to take your money out. You're going to follow me. You're going to believe me until I drop. Meaning that I need your money staying in because I could be spending money for 2 years and 3 years and nothing happens. I mean, it happened in 2008 for them. They made money then. It happened again in 2020. Let's see what happens next. Maybe it works, maybe it doesn't. But these are all of the conflicting issues that you have as an investor. And that's the difficult part. But at the very least, you know that you don't know. You know that the game is stacked against you because they want your money. They want you to take your money and invest it. They want you to believe that you could beat the market. And that works many, many times. Look at this guy that was betting with Robinhood and Hello Kitty, all these stupid stocks, right? And people following because they say, "Hey, work for him with GameStop, and I want in on it." There's no easy job. You have to do your homework. You have to understand what you're getting yourself into. And if you don't understand, you're going to get eaten. They're going to take your money and they want you to be investing because don't forget, if you invest in the stock market, like for example, if you invest, let's say a single stock and you're wrong. Well, the guy that's selling it to you is making money. Okay. Maybe nobody's selling it to you. Maybe you're buying a stock and you're buying in a portfolio. How are they making money? Well, the portfolio manager makes money regardless or not the stock goes up. All they know is their goal is to make sure that you invest in their portfolio. Look at that lady that's always around and banging on Tesla. I forgot her name. She did great for a while because she invested in Tesla. Great showing. She's probably has better showing than me on YouTube. But she's not doing any better now because Tesla is not doing great. She was a one-horse pony. So remember that next time. Remember that you don't know. At least you're aware of the situation. You need to do your homework, understand the risks, and know that you don't know. Don't forget, subscribe to my channel and